Good evening, everyone. It's hard to be the last speaker, but I'm going to try to pull this off and keep you guys interested, but you should probably get some more wine as I do. My name is Denelle Dixon, and I am the CEO and Executive Director of the Stellar Development Foundation. It is such an honor to be here tonight in this iconic building. Thank you for having me. For tonight's address, I was asked to create remarks around the state of crypto. We are far enough into this year to be able to look back and to say affirmatively that 2022 was not what any of us in the industry thought it would be, hoped it would be, or wanted it to be. But I can tell you that as I reflect back on it now, I think maybe it is what we needed it to be, which is a very bold statement, but I'm going to try to back it up. Let me paint the picture for you. At the beginning of the year, enthusiasm and interest in crypto were at an all-time high. New use cases were propagating at rapid-fire rates. According to KPMG, venture capital firms poured $14.2 billion into crypto across 725 deals in just the first half of 2022. But now those investments are slowing, as we heard in the beginning, well short of breaking the previous year's record of VCs investing $32.1 billion across 1,500 projects. So a lot of the industry folks thought that, inspired by El Salvador and them adopting Bitcoin as legal tender, that multiple countries would follow. Crypto would then be part of just what's going to happen be brought to the masses. But a botched technical rollout of El Salvador's Chivo wallet and a series of hacks hindered the mass adoption in El Salvador. And as a result, crypto only comprised 1.5% of remittances in the country. That was back in May, 8 months after the Bitcoin law went into effect. So far, only the Central African Republic has followed in El Salvador's footsteps. Then there's Celsius, and there's also Terra Luna, but I'm going to talk about those in a minute, so I'll come to that later. As 2022 nears its end, and comparisons between crypto and the dot-com bubble grow larger, the big question during the bear market, sometimes people call it crypto winter, you choose, is crypto doomed? As someone who's witnessed and worked through Web 1.0, Web 2.0, and now Web 3.0, I guess I'm old, my answer is no. And let me tell you why. So this year has reminded me so much of my early years on the web. So this is back in early 2000. I was an associate at a law firm, and I was representing some of the newest and coolest technology companies on the web. They were in the dot-com space, that's what we called it then. At the time, the business opportunities on the internet were sort of uncharted, and regulation for the digital world was non-existent. And I kind of loved that. We asked ourselves questions that we had no precedent for to answer. What did monetization look like for internet companies? What happened to privacy, and what do we do with that? What did the terms of service look like, and how in the world do you get users to agree with them? Those were the questions we were asking then. It was exhilarating. It was so exciting to swim in those murky waters. After all, everyone was saying this technology, this new technology, it could transform the lives of consumers forever. And ultimately, we now know that it did. But at the time, it was up to us to define and set the standards for the future and show regulators that there was a path forward, a way to set protections without hampering innovation. Then Pets.com happened. Does anybody remember Pets.com? I do. It's a company that is often used to showcase the excess of the dot-com of 1998. With 2 rounds of funding, Pets.com raised more than $110 million, which they promptly burned through lavish marketing campaigns, AKA this last year on the Super Bowl, and an unsustainable business model. They went public in February of 2000, and by November, they were out of money. In hindsight, it's not surprising that the bubble burst. seeing unsustainable prices and valuations collide with reality. At the same time that institutional investors started crashing out, individual investors were buying into the dot-com craze, and sadly, they were left holding the bag, with 70% of 401ks losing at least 1/5 of their value. Big investment dried up, and unprofitable companies found themselves without a runway and without a sustainable customer base. Shortly after the bubble burst, regulation tightened, and technology started to consolidate around a few big players, with the resources that were there to outlast the bear market. So that's what ensued then. Unfortunately, these decisions ultimately created many of the problems that we see on the web today. So is that happening to crypto industry today? And does that compare to what happened with the blockchain? With the dot-com days? I don't think so, not quite. The dot-com bubble was triggered by the lack of capital for businesses to go on. And as we just heard earlier tonight, the crypto industry is still pretty flush with capital. What contributed to the downturn in the crypto markets are what I largely believe to be unsustainable return yields and subsidies, seeking edge to capitalize returns, resulting in over-reliance on cheap borrowing, otherwise known as leverage. The backing of digital assets on borrowed capital to drive these translate that into unsustainable returns. I like to point this out because nothing that happened in the early part of the summer really had anything to do with the underlying technology, and that's a really important thing. The technology wasn't proven to be useless. It wasn't proven to be broken. It wasn't proven to be bad. In fact, nothing that happened actually really is about the technology. The truth is, leverage is technology agnostic, and nothing that happened then really touched on the usefulness or not of the technology that we call blockchain or cryptocurrencies. I just want to hammer that home. Let's take Terra, for example. I told you I'd come back to it. Immediately before its fall, Anchor, a crypto lending platform, was offering a ridiculous 20% yield for users if they lent UST. I hope some of you got in on that and then got out. 20%. Unfortunately, people still love to believe things that are too good to be true. Terra's team knew that this didn't add up and that it wouldn't be possible to offer this return to everyone, but they justified it as a marketing spend. It's a form of customer acquisition. So when market volatility hit, which seemed to have originated from investors looking to short sell UST, Terra's subsidized yields, they were hollow. Terra was over-leveraged, and it couldn't handle the bank run. Ultimately, individual investors took the hit and lost millions. Now, Celsius shortly followed, touting high-yield returns on deposits to the tune of 17%. So not so awesome as 20%, but still incredibly high and also unsustainable. Their loans were largely collateralized with Bitcoin. So when Bitcoin and the crypto market took a tumble, Celsius customers came rushing to withdraw another run on the bank, only to find out that they couldn't withdraw because Celsius had halted withdrawals, because they'd built a strategy around unsustainable, outsized returns and leverage. Without foundational assets, they didn't have the liquidity to give the customers their money. These companies made lavish promises to consumers, and consumers unfortunately fell for that. And unfortunately, some of these people couldn't afford it. But again, none of it was about the technology. It was about greed and leverage. Still, regulation always follows consumer harm, which is why we need to be prepared for regulation and work towards healthy, principles-based regulation. And to make that happen, we need to engage with policymakers, we need to embrace user-centric design and provide roadmaps and guideposts and flashing bright lights about the risks. And we need to communicate the value of crypto to everyone in crystal clear terms. So I'm going to try to do that for you now. The true value of what makes this technology transformational, just like we talked about in the early days of the web, it's transformational for businesses and consumers, It's interoperability, transparency, innovation, accessibility, and decentralization. And given the time I have tonight, I can't talk about all of those, but I want to start with my favorite, which is interoperability. And if we had had this in the early days of Web 2.0, of Web 1.0, and we had continued to focus on interoperability, we wouldn't be where we are with 5 entities owning the whole. Crypto can bridge existing and new financial systems. It can bridge them together so that nobody has to be excluded from the global financial infrastructure. Yes, I'm talking about financial inclusion, and I'm talking about real-world use cases. Not talking about trading, not talking about investing, I'm talking about what it can do for humans and businesses. Crypto is often described as the usurper of the traditional financial system. Once everyone adopts crypto at scale, goodbye banks, SWIFT, Venmo, but we all know that's not true. Traditional finance, or as the hip and the cool people like to say, TradFi. I'm going to try to use that as I talk about it, but I always refer back to traditional finance. TradFi offers incredible benefits for those able to leverage their services. But while the current financial infrastructure, TradFi, may have intended to be built for the many, the truth is so many are excluded from it. They're de-risked. They're not allowed to participate. It truly only exists for the few. And as often as we talk about that, as often as we talk about financial inclusion and about de-risking and about the unbanked and the underbanked, those individuals or businesses that are too risky to work with the banks, we think about it as something that happens outside of the United States. But unfortunately, that is simply not true. That is not the reality. According to a 2019 survey conducted by the FDIC, 5.4% of US households are considered unbanked. That's nearly 7.1 million people who don't have access to critical financial services in the wealthiest nation in the world. Now, with crypto and blockchain, TradFi can use these incredible technologies to seamlessly connect disparate financial systems and extend their reach into the farthest corners of the globe or into those 7.1 million homes in the US. This is true interoperability. For instance, everybody talks about the digital economy helping the unbanked, but over 60% of the world's adult workforce participants, they work in the informal economy, and they heavily rely on cash. And while the digital economy can make sending international remittances faster and cheaper, or preserve their savings, even people with digital accounts need to be able to convert digital money into paper money and back quickly and affordably. Otherwise, the promise at the digital economy will remain unfulfilled. So this is where traditional finance, leveraging blockchain, comes in. Let me tell you about this really awesome service that's built by MoneyGram International. MoneyGram, one of the most traditional financial companies that exists in the US, developed an integration with Stellar, an open source public blockchain network, to provide people cash to crypto on and off ramps. With these ramps, people can go to a participating MoneyGram, you can go to one right down here in San Francisco, and convert your cash into Stellar USDC. USDC is a stable coin. It's not a volatile cryptocurrency. When you're sending payments, you want to use a true stable coin, one-to-one backed with fiat, sitting in an insured financial institution. So they can convert that immediately into USDC held in their digital wallets. Within literally a minute and a half, you can do this throughout the you can do the whole process in that time period. This right now is available. What does that mean first? It means that you don't have to have a bank account or a credit card to actually be part of this new financial infrastructure. You can actually take cash into MoneyGram and convert that into USDC and then send that USDC to your family abroad, to your family in another part of this country that doesn't have a bank account. They can then hold those assets or do what they want with those assets. This is available in 400,000 locations globally that MoneyGram has. So you can do cash out in those 400,000 locations, and in 14 of those countries, you can actually do cash in as well to convert into stellar USDC. With USDC or other stable assets, people can use their money in ways they couldn't before. They can send it to another wallet, as I said, anywhere in the world, or hold it for as long as they need to. They can protect themselves from devaluation, which I know here we actually hadn't had to think about until maybe this year, but elsewhere people think about it all the time. Before this, to get access to the crypto assets, you needed that credit card, that bank account, which sort of defeated the whole purpose of the flexibility and control that this technology allows. This is an incredible innovation. Never before have people had such easy access to crypto. In this case, the power and value of a trusted digital dollar and the digital economy. So next, let me touch on the values of openness and decentralization when it comes to these real use cases. Why are these values so important? They are for so many reasons, but mostly they drive innovation and empowerment. Software that is open and decentralized allows others to build on it without permission. MGI gets bonus points in my book because, in my opinion, this integration is built on open source decentralized software. And it means that any wallet or application can develop with this integration in mind and could get ready on their own to provide their users access to MoneyGram's on and off ramps. They don't need permission. It's just available to them. And also, any traditional financial institution could follow MoneyGram, and they could follow MoneyGram's lead and create their own cash to crypto on and off ramps for their customers. The tools are out there and available and can be built. End users are ultimately benefiting from the work done in the open. And decentralization is key because it removes intermediaries and puts end users in control of their own assets. There is not a single entity that can actually shut down an open, public, truly decentralized blockchain, because there is no one entity that controls it. People don't have to fear that access to the technology will ever disappear due to a single point of failure, or because a centralized entity can charge excessive fees to price them out of the market. The user is able to remove expensive intermediaries that may be custodial. The users get to hold their own assets, their own keys. They get to control what happens with their own assets without fear that anyone, any government, any entity can take those assets away from them, which is a fear that many actually have outside the United States, and some here as well. The technology helps create empowered users while allowing access to tools that help them create a better financial future. This cash to crypto service is powering real-world blockchain solutions to solve real-world issues and create more equitable access to the global financial system. Local wallets everywhere can rely on the power of a safe fiat-backed dollar in their product and reach those cash-based users relying on the MGI integration. This is nowhere near the end of crypto. In fact, it is just the beginning. As more and more financial services come to blockchain, people based in cash economies will gain access in the same financial services that we take for granted here. Well, now is a tough time for the industry. It's been a tough year. It will challenge us to mature in the same way that the dot-com bubble changed the trajectory of the internet companies. Let's not repeat and go down the route of Web 1.0 and 2.0. With Web 3, we have a chance to carve out a truly radical and truly inclusive future for all. We need to avoid the biggest risks facing crypto today. Those risks to consumers, putting them in positions where their entire life savings is evaporated in hours, and the risk of centralization and turning to consolidation as a means to get through this crypto winter or this bear market. That's where we risk stifling innovation, competition, and the ethos that guides so many in this industry who believe in the technology as the means of an open, accessible financial system. These are the lessons that we need to learn now and the decisions we need to make to set the course for crypto's future. But I'm a believer, not just for the power of this technology, but in the good that it does today and can do tomorrow. It is a technology that is poised to make the world more connected, borderless, and more fair. Thank you.